Bismillahirrahmanirrahim. In the previous class, we discussed about index analysis and common size analysis. That was the end of chapter number 4. Today, we are going to start chapter number 5, and chapter name is Working Capital Management. Now, first of all, what is working capital? Working capital is the amount required for running the day-to-day operations of the business. Whenever you start a business, so you need land, you need building, you need machinery, you need furniture, you need equipments, these are called fixed assets. It is also called fixed capital. Now, except these things, you need some other capital. Suppose you purchased land, you made a building on that, you purchased machinery, you purchase furniture, you purchase equipment. Suppose you spend 10 million Afghanis, 10 million Fs on these things, on purchasing land and making a building on that, then purchasing machinery, furniture and equipment. Now the money is finished. You don't have more money. So now your business, it will be stopped. Why? Because for running the operations, you don't have money. You need additional 1 million Afghanis. Why? Because you will purchase raw material, you need cash in your business for paying the salaries, for paying the expenses, transportation expenses, for other expenses. You also need some money to sell goods on credit, that is receivables. So you need money for these things. If you don't have money, $1 million, your business will not function. The operations will be stopped because you don't have raw material, you don't have cash for paying the salaries of the employees, for purchasing the raw material, for the daily expenses, food expenses, transportation expenses, marketing expenses, different other expenses. And if you don't have enough money, you can't sell goods on credit, receivables. So for these things, you need money in your business. Now take an example. Suppose all of your class, you made a plan that you will go to a dinner and you will go to a hotel, suppose any hotel. What we did, we went there in the hotel. In that hotel, when we entered, so we saw that there were candles. You know about candles. So there were candles. There was no electricity. The building, it was a good building. They have good furniture. Each and everything was outstanding, except electricity. There was no electricity. So we went there, we sat on the chairs, so a waiter came for taking the order. He took the order. We said that bring this thing, and this thing. We were 10 people. So he tell us that first you will make payment. Your bill of these things, it will be 10,000. So first you will make payment. We said why? First you will bring the things, we will eat, then after that we will make payment of 10,000. He said that sorry, we don't have money. We don't have money to purchase these things. First we will purchase these things in the bazaar. Then we will prepare food and then we will serve the food to you. So what was the problem there? The problem was that they don't have money for the operations, for day-to-day activities. So that's why he was demanding money in advance. And there were candles because they didn't pay the electricity bill. They didn't pay the electricity bill. So the electricity department, they cut their electricity. We were thinking that maybe it will be candlelight dinner, but the situation was not that. The situation was they didn't pay the electricity bill, so the electricity department, they cut their connection. And the waiter was demanding advance money because they don't have money to purchase the food material. So he was demanding advance money to purchase food material. He will bring it, then he will cook it, and then he will serve it. So what was the problem in this hotel? The problem was that their building, it was a very good building. They have very fine furniture, well furnished furniture. Each and everything was fine. But the problem was that for day-to-day activities, they don't have money. So this money, which is required for running the day-to-day activities of the business, This is called working capital. So working capital is the amount which is required for running the day-to-day activities of the business. So working capital is the amount required for running the day-to-day operations of the business. Mathematically, working capital is equal to current assets minus current liabilities. Basically, if you will look at this formula, working capital, I'm writing shortly, is equal to current assets minus current liabilities. The difference between current assets and current liabilities. Now, which things are coming in current assets? Cash, receivables, inventory, prepayments, etc. So these are the current assets, this thing. And what are the current liabilities? Payables, account payable and note payable. The money that we purchase goods on credit. If you purchase goods on credit, that will be your payables, that will be your account payable and note payable. Okay, so it will be account payable, current liabilities, account payable and note payable. So suppose you have cash of $100,000, receivables of suppose $50,000, inventory of suppose $1 lakh, and prepayments, suppose you paid advance payments for something of 10,000. And your current liabilities are, suppose your accounts payable are 20,000 and your notes payable are 10,000. So now see what will be the difference. 1 lakh plus 1 lakh plus 50,000, 2 lakh 50, 2 lakh 60,000. $260,000 minus 20 plus 10, 30,000. So you required 2 lakh 60 minus 2 lakh 30, we got 2 lakh 30. So this amount of $230,000, we need this $230,000 for running the day-to-day activities. Now, day-to-day activities, take the example of Salam University. What are their day-to-day activities? They have a building, they have furniture, they have multimedia, each and everything, each and every facility. But suppose if they don't have cash, they will be unable to pay salaries, They will be unable to pay rent. They will be unable to pay the food expenses. They will be unable to pay transportation expenses. They will be unable to pay for advertisement and different other expenses, stationery and different other. So if you don't have money, you will be unable to pay these expenses. And when you are unable to pay these expenses, your business will be stopped. So the money which is required for these expenses and for running the business, for running the day-to-day activities of the business, we call it working capital. According to Brigham, working capital refers to the firm investment in short-term assets. Investment of firm in short-term assets, it is called working capital. Like cash, that firm is keeping short-term securities, T-bills, commercial papers, investment in T-bills and commercial papers, receivables, money which is blocked in receivables, means when you are selling goods on credit, and inventories. The inventories that a firm purchased. So we call it working capital. Now, types of working capital. So working capital is simply the amount which is required for running the day-to-day activities of the business. Now there are different types of working capital. On the base of value, we have two types of working capital. On the base of value, we have two types of working capital. One is called gross working capital and other is called net working capital. And on the base of time, again, we have two types of working capital. One is called permanent working capital or fixed working capital, and other is called temporary working capital. We will discuss these in detail in the next slides. Now, first one, it is gross working capital. Gross working capital is basically current assets in the balance sheet of a business are known as gross working capital. The total current assets of the business, we call it gross working capital. It denotes the company's overall investment in current assets. So he's telling you that gross working capital is basically, suppose this is your balance sheet. In this balance sheet, you have current assets in which cash, inventory, receivables, prepayments, etc. These are coming. So these are the current assets. Then there are fixed assets. In fixed assets, we have land, we have building, we have furniture, we have machinery, we have intangible assets. So the total money that we are blocking in current assets. Suppose in our example, the total money that was blocked, it was 2,60,000. 1 lakh was cash, 1 lakh was inventory, 50,000 receivables, and 10,000 prepayments. So the total money that is blocked in current assets, it is 2,60,000, 260,000. And this total money blocked in current assets, this is called gross working capital. So gross working capital, current assets in the balance sheet of the business are known as gross working capital. It denotes the company's overall investment in current assets. So it denotes the company's overall investment in current asset. Gross working capital is equal to total current asset. Just like here I told you, total current assets, these are 2,60,000. So this 2,60,000, it is called gross working capital. Now come to the second type of working capital on the base of, here we discuss that on the base of value we have two types. One is gross working capital, the other is net working capital. Net working capital, it refers to the surplus of current assets over current liabilities. Now these are current assets. On this side there are also current liabilities. In current liabilities we have account payable, we have note payable, and we have some other payments, other payables. Account payable, it was 20,000, and note payable, it was 10,000. So total it becomes 30,000. So net working capital, it is the surplus of current assets over current liabilities. Surplus means 260 minus 30. So 2,60,000 minus 30,000 . So we got 2,30,000. This 2,30,000, it is the surplus, means it is the more money, additional money. If we paid current liabilities, we left additional 2,30,000. This additional 2,30,000, this is called net working capital. So net working capital is basically the difference between current assets and current liabilities. If this net working capital, it is positive, plus, now see it is in plus, so it shows that we can pay our current liabilities easily, that we can cover our current liabilities easily, means we can pay our current liabilities easily with our current assets. We have 2,60,000 of current assets and we have 30,000 of current liabilities. So in from 2,60,000 current assets, we can easily pay current liabilities. So this is called positive net working capital. Positive net working capital. And if it is negative, suppose current assets are less and current liabilities are more, so it shows that we cannot pay our current liabilities with our current assets. So here he's talking about this. Net working capital, it refers to the surplus of current assets over current liabilities. Positive net working capital shows the company's ability to cover short-term liabilities, and negative net working capital means the company cannot pay the current liabilities, the short-term liabilities. Vice versa means the reverse of this. Negative net working capital means the company does not have the ability to cover short-term liabilities with their short-term assets. So net working capital, what is the formula? Current assets minus current liabilities. Now, on the base of time, again we have two types of working capital. One is called permanent working capital. And the other is called temporary working capital. This is on the base of value. We have two types, gross and net working capital. And on the base of time, again we have two, gross and net working capital. Now what is, not on the base of time, we have permanent working capital and we have temporary working capital. Now what is permanent working capital? Permanent working capital, it is the minimum level of investment required for running the day-to-day operations of the business. When you are doing a business, so for running that business, monthly you need this amount. You always need this amount in the business. Take the example of Salam University. They are paying $10,000 rent. Rent of the building. They need at least $50,000 for paying the salaries. They need, okay, 5,000 for the food expenses. They need, suppose, $2,000 for the transportation. They need, suppose, $3,000 for advertisement. And suppose they need additional 5,000 for other small expenses. So 10,000 plus 50,000, 60, 65, 67, 70, 75. So $75,000, they always need this money. So 75,000, that is my estimate. So they always need $75,000 in the business. If they don't have $75,000 in the business, their business will be stopped. So that money which is always required, that working capital which is always required in the business for running the operation smoothly, we call it permanent working capital. Inshallah, in the next class, now the time of this lecture, it is 30 minutes, so you people will be bored. So inshallah, in the next class, we will go in detail of this topic, permanent working capital. So for today, I think it is enough. Inshallah, in the next class, then we will talk about permanent working capital, temporary working capital, then diagrammatic presentation of these, and approaches of working capital, aggressive approach, conservative approach, and moderate approach. Okay, assalamu alaikum.